make it through times like we're going through today. It's also important to emphasize cash flow. I think that having some cash flow associated with an investment is very important. Not always the most important, but having some cash flow shows that shows that a company clearly is making money. They're not doing funny things with the books that have happened back in the internet days and what's going on in China and some of those accounting issues. And taking safe withdrawal amounts goes right along with cash flow. You can't take out 10% of your investments on an annual basis and think that that's going to last for a long period of time. We'll get into that a little later, but some people have unrealistic goals, and sometimes we have to talk them out of that and talk them into more realistic things. Another thing that we think is really important to building really lasting portfolios is resisting the temptation to buy the really high yielding securities. And that is never more true than today. When the 10-year treasury yields less than 1% and A-rated 10-year bonds, yield 1.5% or 1% when someone's willing to pay you 7, 8, or 9% on an investment, there has to be significant risk associated with that. And people need to understand that and not have too much of it. Otherwise, they're really going to risk blowing up their whole portfolio. Liquidity, owning investments that are liquid, knowing that you can get out and get in when you want to is extremely important. And creating a game plan for putting the money to work. A lot of times we talk about, today would be a perfect example. Someone gave me a large amount of money today and their time frame wasn't more than 10 or 20 years, I would have a hard time putting it all to work today. I think, there's a lot of things going on, and maybe you put it in dollar cost averaging is a better plan. Some more investment philosophy. These quotes are from Benjamin Graham. He's the father of value investing and Warren Buffett's mentor. And some of these, I think, really resonate with what I see on a daily basis and when I talk to investors out there. The individual investor should act consistently as an investor and not as a speculator. And I think that's where people get in trouble when they talk about investments that are speculative and they want to buy them because they're going up, but they really don't know what's behind them. And like I talked about before, very high yielding securities are speculative, and people need to understand the difference. The second one, without saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow. And that it's never so more true than today, right? If you don't believe that the U.S. economy is going to be in a better place than it is today, 5 or 10 years down the road, then you're going to have a hard time putting money to work. And we need to believe it. It's always happened. I believe in the American entrepreneurial spirit, and I believe in capitalism. And people know how to figure out ways to make money, and they always will. Individuals who cannot master their emotions are ill-suited to profit from the investment process. And that goes along with number 2 there. If you can't believe in the future and you panic when the market sells off 10 or 20%, then you're never going to be able to profit from the true investment process. And that means, you need to be able to deal with the ups and downs of the market. The investor's chief problem, and even his worst enemy, is likely to be himself. And, behavioral finance tells us that people have a hard time with their emotions when it comes to investing. And it's so clear. You can see that people sell at the bottoms and buy at the tops. And history repeats itself over and over and over. And you need to be able to put your emotions aside and constantly put money to work in good times and bad, and things will work out fine for you. You do not have to trade with him, Mr. Market, just because he constantly begs you to. It's kind of the same thing. That's like buying at the top. You know, as the market rallies like it did at the internet bubble, and high flyers are gaining 100% monthly, you know, people couldn't put money in fast enough and they forgot about the risks. And the market is just begging you to put your money to work when it acts like that. And you have to have some discipline and be willing to say, I'm just going to constantly put the same amount of money to work no matter what. So let's get into, you know, today's investment environment. Where are we? And honestly, you know, we can't talk about the investment environment without talking about the current pandemic. It's at the top of mind. It is affecting every part of everyone's life. You know, there are more questions than answers at this point, but we have to follow this and know what's going on. We've been following this here in the office, this chart, every day since the middle of March. And this tells us daily new cases of COVID. And you can see the top part here, the light blue is New York, and they've done a tremendous job of flattening that curve. The second one is the whole country, and things have gotten slightly better, but overall, I wouldn't say we have crushed the curve yet. New Jersey, much like New York, has really done a good job, and we should feel good about that and just be careful that we don't backslide too much so that you know, things have to get shut down again. And you know, there's a few other states I threw in there: Florida, Arizona, and Texas. We all know what's going on there. They are having a resurgence. My bet is we're not going to have a total shutdown of those economies, but things are going to stop because of that. You know, whether it's school in those states or Apple stores announced yesterday that in Florida and Arizona, they're going to close stores again. That's not the end of the world, but you know, it's clearly a step backwards. And we're going to have steps forward and steps backwards. The question is, when do we have a vaccine, right? That's probably the most important thing to know. And we'll get to that in a minute. Along with our current investment environment, we're talking about an unprecedented response and support from the federal government. I am not one who gives much credit to the government on a daily basis, but I will say in this case, the government has done a tremendous job in responding to the financial needs of individuals, small businesses, and large corporations. They have spent 4 times the amount of money that was needed in the 08-09 financial crisis, and did so in a much faster manner. They did it quickly. One of the reasons they were able to do it quickly is we had a playbook from 10 years ago, and that playbook was used extensively. You know, so the part of that playbook is targeting rates at near zero, supporting the functioning of the markets, and that means buying stocks and bonds, backstopping money market funds, backstopping repo, things like that. They're encouraging the banks to lend. I wish they would, but there's not a whole lot of demand at the moment. But they're encouraging it. They're relaxing regulatory requirements, and they're direct lending to the banks. They're also supporting households and consumers with lots of cash. The PPP, the Main Street Lending Program are all keeping small businesses alive, and you know, I think they're doing a very good job there. I think there'll be some more money to come for them. The most important thing to remember is the federal government actually has more ammo available if things were to get worse. I think in the next few weeks to a month, we're going to see some checks, more checks to go to consumers, and we're going to see more money for corporations and markets. But it's really important to remember the old adage: don't fight the Fed. The Fed has more money than any of us, and can prop up markets for long periods of time. Let's talk about some of the changes. There's a lot of changes going on, seismic changes going on in the economy, but these changes create opportunities. The pandemic, much like the 08-09 financial crisis, is an accelerant of change. If you're looking to take advantage of those opportunities, there are a few obvious ones. The retail retail moving from bricks to mortar to online, that was happening anyway, but this is just going to make that much, much faster. I think it's pretty clear if you look at the real estate market here in Chatham, all of a sudden it's on fire again. And why is that? Well, I have clients that can't get out of New York fast enough to move out to suburbia. So where there was a flight in the last few years of suburbia to the cities, it's now, because of this pandemic, reversing. I have an aunt trying to sell a house in upstate New York, put the house on the market on Friday. She already has 4 bids. I mean, the market is really, really, really strong here in Chatham at the moment. Healthcare, most of us know, have probably dealt with a health professional via a Zoom call or some sort of call, or telemedicine. My daughter has had free telemedicine, and last year she was able to get on there and do some things with doctor. I had never seen that before, and now because of this pandemic, it's just moving along much, much faster. So I think the trillion-dollar question about this current environment is, when will consumers return to 2019 spending levels? This is really, really important. And I think what the federal government is doing, their job, is to keep the economy afloat until we have a therapeutic or a vaccine that allows us to go back to living a normal lifestyle. And I don't think we're going to get back to a normal economy until 2022. We may have some sort of vaccine or a vaccine later in this year, but it probably won't be made available to the masses until sometime into the middle of 2021. So I think 2022 is a pretty good barometer of when we will recover, and we'll talk about that a little further. But so when will consumers return to spending levels? The chart on the right is money supply and the velocity of money. The blue line shows the money supply almost doubling in a few months. So we know everybody has gotten checks, people are making money, people are sitting on money. In fact, the savings rate, you can see there, my stat there on the left, U.S. savings rate rose to 33% in April, the highest level on record. Before the pandemic, the savings rate was 7%, and that was a 20-year high. So people are saving money. The economy will recover when we start spending the money. And back to my chart on the right, the gold line is the velocity of money. The velocity of money is how quickly does money change hands, transactions. Right now, there are very few transactions. All that money is sitting in the bank. So when that reverses course and we get back to 2019 spending levels is when I think we'll be in good shape. And we can start talking about, once I get into stocks, we'll talk about earnings and some of those other things. But let's move into the different asset classes of and what we think of them at this moment. So what is the landscape for interest rates and bonds? My chart says it all, right? They've fallen very, very quickly, down to near zero. A 10-year treasury yields 74 basis points. A 2-year treasury yields 19 basis points. There's no yield on CDs to be found. A-rated corporates for 5 years, 1%. A-rated munis, 1.03. These rates are not very attractive. And locking into some of these longer term rates, that you have almost zero chance of even keeping up with inflation. But you won't lose money. And that's why there will be money, and there is money going into these things. So our recommendation for bonds at the moment is to buy individual bonds to control cash flow and quality. When you buy an individual bond, you know exactly when you're going to get your interest payments and when you're going to get your money back, which is different from a bond mutual fund. We also don't think you should lock into a large amount of long-term bonds at these very low yields. We should stay shorter on that curve. And then we should utilize cash alternatives to give yourself flexibility. There's a lot of very short bonds that pay a decently attractive rate, more than 1%. That's a good place for cash at the moment. Let's move on to what is the current landscape for stocks. As I mentioned, don't fight the Fed. That's a positive, right? The Federal Reserve is buying stocks and bonds. The Treasury Department giving money to corporations, small businesses, and individuals. And stocks are attractive because they yield substantially more than bonds. The negatives with stocks in this environment are, we don't know the answer to when we'll return to those 2019 spending levels. We don't know what earnings are going to be, and we don't know the stops and starts that we're going to have with reopening. So it's all about getting through the next 18 months to 2 years. And one of the other negatives I threw in here, these two charts here, I talked a little earlier about the internet bubble days. Well, a lot of kids or younger people and investors in general are now opening brokerage accounts with the money that they've received from the government, and they're buying speculative stocks that are going up every day. And you can see on the left the increase in brokerage accounts in the first quarter of 2020 in dark versus the first quarter in 2019. So many, many, many more brokerage accounts being opened. And then NASDAQ, where a lot of the speculative names are, look at the amount of volume that's happening there. I'm not saying that bubble is going to burst anytime soon, because bubbles go on for a long time. But these two charts, along with the fact that last year most of the brokerages started offering free trading, are fueling the fire. So that's definitely one of the negatives. Corporate earnings are the single largest driver of stock returns, or where the stock prices are going to go. In 2019, the S&P 500 had earnings of $163 a share. Projections for 2020 are $127. We'll get back to about 163 in 2021. Some people have it closer to 150, but the consensus for 2022, and that's the time period I'm thinking about, we're going to get back to that $170 to $175 level. That will be those earnings will be better than where we've ever been, and that's what people are looking for. Also, which sectors' earnings have been the least and most affected? It's probably no surprise to you that utilities earnings were the least affected and energy earnings were the most affected. So my recommendations, or our recommendations for investing in stocks in this current environment, is emphasize quality. I can't say quality enough. And quality in terms of stocks means strong balance sheets, strong cash flow, having a business model that can capitalize on the opportunities that are going on in the world, and that the management has a track record of making money in both good and bad markets. That's what makes up a quality investment. Don't make large bets. Again, I want to emphasize diversification. Cash flow. We talked about cash flow. And I'm talking about buying stocks that are fairly valued and can compete in a new business landscape. You know, fairly valued is a little bit of a vague concept in this market because there are so many question marks. But you have to have, as Benjamin Graham pointed out, you have to have faith that we're gonna see better days. And another thing that John Rabb, my mentor, taught me is always keep some powder dry. We expect more volatility, not just from this, stopping and starting of the opening of the economy, but we have the election coming up. There's a lot of things that are going to drive this market up, down, and sideways. And opportunities will present themselves. Keep some powder dry to be able to put to work should opportunities present themselves. International stocks. I think this is the most overlooked asset class when I see clients, new clients come in or people who want me to look at their portfolios. International stocks are clearly the most underweighted. And over time, they have shown that, you can see on the bottom there, that annualized returns of a portfolio made up of 70% US and 30% international has the same return of the US portfolio 11.3% annually. But it has a 10% lower standard deviation. And that means that you get the same return with less risk by adding international stocks to your portfolio. The graph up here on the right shows us probably why that is, because we go through periods of time where US stocks outperform and international stocks outperform. So that means they're not always 100% correlated. So when you add an uncorrelated asset to your portfolio, if one asset goes down, the other goes up, that helps the risk return parameters. Other things that we like about international stocks now is that they offer better income opportunities and they have better valuations than we currently have here in the US. So we're big believers in adding international. Let's see here. Okay. Other potential sources of income from asset classes. We call these satellite strategies. We call cash, bonds, stocks, international stocks is kind of our core portfolio asset classes. And then we have satellite strategies. These are other higher yielding investments that could add income and potential total return to portfolios, but they come with higher risks and should not be part of the core. We consider these satellite strategies. Many of you probably have heard of REITs, real estate investment trust, business BDCs, business development companies, bank loans, convertible bonds, closed-end bond funds, and master limited partnerships. Depending on your income needs and your risk parameters, we can add these to your portfolio. We have a long investment track record of investing in these areas. So let's talk about asset allocation and portfolio construction. Helpful tips for building safe portfolios. Portfolio allocation is dictated by risk tolerance, time horizon, market conditions, and income needs. Helpful tips for building the safe portfolios. Rely on as little appreciation of assets as possible. That makes your portfolio stronger if you can generate the income that you need and then have other money left over. If you have a longer time horizon or can easily meet your income needs, you can afford to take more risk. Matching your income to your expenses. We talk about that a lot with our clients. If they need $50,000 or $100,000 worth of income, can we easily produce that, or do we have to rely on a certain percentage of appreciation? And I think the bucket strategy, many of you have probably heard of, it's a long time strategy. It's very successful. It's been out there for decades. Is a great way to think about portfolio construction. What you do is we create 3 buckets. The first bucket is your emergency money, 6 to 12 months worth of expenses. That money gets invested in, make sure you have that money set aside. The second bucket gets investments fulfilled from the income needs. So the income that you need goes into the investments in the second bucket. And then the third bucket is the longer term that can be allocated more towards growth. So what is the optimal income stream for you? And it makes it difficult in this sort of Zoom presentation because we can go in any direction from here. This is a pretty standard middle of the road portfolio in terms of asset allocation, but we're not talking about what type of investments and what sort of income is in here. Within the US stocks, we can talk about doing, 1% growth, 50 basis points of, 1% income, 50 basis points of income, which would be mostly growth stocks, or we can build it to a 3 or 4% income. It's really being able to customize each one of these portions of your asset allocation to fulfill your custom needs. Back to the bucket strategy, and that's really what I want you to take away from this tonight, is this is the simplest way to think about portfolio construction and allocation. Bucket 1, that whatever your emergency need is, 6 to 12 months worth of expenses, can be fulfilled by having cash and short high quality bonds. Bucket number 2, your income needs can be fulfilled through bonds and quality dividend paying stocks. And then bucket number 3, your long-term growth needs can be fulfilled with growth stocks, international stocks, and some of those satellite strategies. And really, like I said, we can cater this any way you like, and we have some tools that can show you in terms of retirement planning, second home buying planning, college funding planning, that really make it easy for you to see where you're going and to create that plan that you need. So I'm going to end it here. If you want to get started with planning your retirement, with a little flexibility in planning, Chatham Wealth can broaden your income options in your favor. We, as I mentioned, we have a sophisticated planning tool. It's very simple. We can get any of you started. And this tool can tell you, do you have enough money to retire? What is the probability of success? And success is measured in living the lifestyle you desire in retirement, tracking your progress, seeing all your assets in one place, knowing how much risk you're taking, running 500 or 1,000 scenarios that show you both good and bad, not just a straight line scenario. Where to take money in terms of the most tax efficient way to withdraw your money for your needs, maximizing Social Security, measuring your net worth, and planning for any number of your life events. So at this point, I'll turn it over to anyone who has questions, and hopefully I can help you answer them.
You can either put your questions in chat, or if you want to unmute yourself, you can do that and ask your questions. Any questions? All right.
I don't think we have any questions. Well, thank you, everybody.
Excellent. Yeah. Dan, this was great. This was awesome. I really thank you very much for doing this for us. And I will get the recording over to Sharon as soon as possible. Hold on.
I appreciate it. Thank you very much for your time. And
Dan, we do have one question. I think the best bet is probably if you, it says, TA says, what are the costs to have this initial conversation?
sure.
Go ahead.
There is no cost for the initial consultation. We have a free consultation here in the office or in this environment via a Zoom call. So you can reach out to us to set that up at info@Chatham Wealth, or give us a call at the 800 number that I had on there, 800-472-8086.
Excellent. TS says, sorry, TA says, great, thank you.
Great.
All right. Well, any more questions? Okay. All right. Well then, Dan, thank you very much. And we will have this, I will forward it to you, and we will also post your program on the Chatham Library website under local businesses within the next couple of days.
That's
Thank
great.
you very much.
I really appreciate it. Thank you for, doing your work here at night for me. And
Mm-hmm.
I enjoyed it. Thank you very much. Have a great night.
Thank you. Have a great night, everybody. Bye-bye.
Thank you, Dan. Have you ever been a teacher?
No.
You're so good at explaining things.
Really? Oh, wow.
Thank you.
Thank you. I appreciate that.
Okay.
All right. I'm going to take off. Thank you, girls. Have a good night.
Okay, let's stop recording. Okay, have a good night.
Thanks.